So guys, good morning and welcome to Leaders Mastermind. And as a network, we've got a special guest today and none other than Dom Thompson from the legendary Macquarie Bank. Dom, as head of real estate, you must be seeing a few twists and turns at the moment.
Fair to say. I think that's an appropriate way of saying it.
Yeah, and where are you coming in from today?
So the lovely Brisbane, bright blue skies, but a few degrees lower than what it would ideally be. So a bit of a chill.
Yeah, but best we not talk about Gold Coast temperature and Brisbane temperature when we've got some Victorians in the mix and some Sydneyites there as well. So guys, one of the things that I think MacBank does exceptionally well is the research and the market reports and the benchmarking to be able to give us insights and perspective. If there was ever a time, and I remember Simon Jovanovic talked about rapid adaptation right now, there's a lot of you that have made some fantastic decisions about pivoting your business and shifting the model and so on. What I'd love you to listen to today and listen in for is there a strategy, a perspective and so on? Because we are going to go into a 12-month planning process for the next 12 months and a real focus for the next 90 days. So I massively endorse a 30-day plan for the month of June. And then we're going to actually shift into what are we going to achieve in the next 90 days. And Dom, just so you know, we've really been focused on what do we need to do in the next 30 days? What do we need to do in the next 30 days? And we're shifting our sights to a 90-day plan for the first quarter of the financial year, of the Australian financial year, that is, from that point of view. So Dom, I know we've spoken about, responsiveness, resilience, adaptation, and so on. And no doubt that is the absolute key to working on the business as well as working in it. So there's a lot of deals to be done right now, but they typically need a fair bit of leadership support to get those across the line. And then on the flip side of that, clearly there's some on the business work that we need to do to make sure we're business fit for the long term, not just a short-term game. So, hey, thanks for being here and thanks for sharing your insights and perspective that MacBank have actually gained.
No, Jarvis, thanks, Mike. So I will...
Hang on. Dom, can I just... Dom, I'll just get you back and you can start that whole sentence again.
Sorry. Yeah, no, thanks, Mike. I appreciate the opportunity to join this morning and looking forward to sharing some of our insights from Pulse Check that support this real theme of adaptation and resilience. So hopefully I can now share my screen and we will go to...
It's looking good.
Looking good. Let's just go to the slideshow. Okay, that's come up full screen. Everyone can see that.
It has. And Dom, just as we're going through this, as a heads up, how many of these can we share this slide pack, or should the guys take some pics along the way?
No, I'm more than happy to share the slide deck post the event. So I'll send that through to you, Michael, for you to share with the broader group.
Perfect. You get a huge thumbs up from everyone for that one.
Excellent. Always good. Righty ho. Okay. So, the intention today is to really share some of the insights from our Pulse Check that we took to market at the back end of last year. I think just looking around the room and seeing a lot of familiar faces, a lot of existing Macquarie clients and just people that I know that either myself or our extended team have met with over due course and has been privy to our benchmarking, which I think is held in pretty high regard within the industry and something we were certainly looking forward to coming to market with again. So themes of resilience and adaptation, I mean, no real surprise. This is something that we've been talking to the market about at least for the last few years from our initial Perspective conference where we, just trying to slide through, put the slides through, where we brought to market this theme of 3 horizons of growth, which was a model that we were talking to the market around as to how to adapt to this transformational change that was playing out and had been playing out for a period of time. So a couple of years ago, we talked about the wave of prop tech. We talked about changing customer expectations. We talked around a whole range of different things. And there was also this thing that was happening in the market that APRA was playing around with servicing overlay guidelines for banks. And arguably it was that had the most significant impact 18 months ago now, or practically 2 years ago, on the Australian landscape. And we talked around at that time, with all of these changes playing on and all of these factors of change coming through, how are we going to navigate that, and providing a framework by which we believed, and we still believe, our clients and the industry more broadly can utilise to be able to adapt to this changing market. It's actually a model or a framework that we've been using within our business, because the financial services landscape is certainly changing. If not ahead of the property services space. So we're still very much supportive of this framework around 3 horizons: lowering cost to serve, driving efficiency through automation and technology. We still want to see the industry look to build out additional revenue streams and serve the broader needs of its clients, and still have this real leadership visionary mindset around creating a genuinely new business. And really, without that in mind, it's hard to navigate the first 2 horizons to ensure that those decisions are aligned to that long-term vision, albeit all of these horizons do play out at the same time. They're certainly not mutually exclusive, where you have to kind of go through horizon 1, 2, and 3. So that's what we were talking about 2 years ago, and we kind of danced around this theme of adaptation. But for those that were able to attend our Perspective event earlier this year, we talked very much around this theme of adaptation through the work of Michael Manus and the Universal Arc of Organisations, which is really an extension of this 3 horizons theme that we brought to market a couple of years ago, that I think the industry is very familiar with. And this was all about understanding the universal arc of organisations. So this arc and this growth pattern that all organisations go through, and really where we see a lot of the property services industry at the moment, and we look a lot across a lot of the players. Many who are dancing around this sustain and defend, and many also in this successful stagnation phase, where there's really this disruptive dilemma of, well, where do we go to from here? And if we don't look to reinvent ourselves and arguably disrupt ourselves, we run the risk of heading towards desperate decline and demise. I know that sounds a little bit catastrophic, but really challenging the status quo and the success that we've all benefited from a very favourable sort of backdrop within the Australian property market for a few decades now, albeit with a few glitches, but really challenging the industry itself to challenge itself through this disruptive lens. So that's the backdrop and how we're sort of framing a narrative. It's always good to have some actual evidence to support some of the themes that we're seeing, but also to share some of the insights of what's working and what some of the high-performing businesses out there are doing. So when we took Perspective to market at the back end of last year, we were reporting off of FY19 data, which was obviously a really interesting sort of point in the market. We had 12 months of pretty poor environment, trading conditions, but it was also really the market where things started to improve. So the key for us when we were asking, or when we dropped this in market last year, appreciating a backdrop where the market was actually picking up, but in the financial sense, it probably wasn't hitting the P&L yet. So we were feeling optimistic because activity was improving, but the financial actual characteristics of a lot of businesses were still turning at that stage. So we wanted to understand, well, how are agents performing, and obviously, what are the characteristics of some of these high performers, so that we could reflect that back to the industry more broadly. The pulse check for last year was the best benchmarking exercise that we have ever conducted. And when I say the best, it was the highest engagement, highest number of participants. You can see there in the bottom left-hand corner, it wasn't quite double, but it was certainly a very strong uptick on our previous benchmarking surveys. We've been doing this for 10 years now. We don't do it every year. It's typically every 18 months to 2 years. But a really strong engagement, which I don't think was really any surprise, just given how challenging the backdrop had been for a period of time, and people were really looking for some guidance on what was happening out there and more broadly in the industry, and keen to see what others were doing. As I said, equally, what those high-performing agencies were also doing. So you can see from the geographical representation, we had a really good data set from all states. First time we've been able to get one for SA, which is a fantastic outcome for us. And the metrics there around the turnover of the industry, so that's what those numbers are relating to the sub-mil up through to the +5 mil, demonstrates that there's a really good mix of business size that we're reporting through as well. So we really felt it was a fair reflection of the market in each of the states, and gave us some really good confidence around the numbers that were being reported through to us. Again, these aren't just our clients, this is the industry broadly that is reporting through to us. So 3 key themes that came through, and then we'll touch on some of the characteristics of high performance. The first theme that came through is that commissions continue to come under pressure. I don't think this is really a surprise to anyone. It's something that we've known and observed anecdotally, but it's great to have the data here to support this. So I don't want people to get too caught on the numbers, because I know there's always a story to be kind of told and a conversation to be had. Specifically around the state numbers, but it's the trend here that I want people to focus on. And you'll see on the left-hand side a national downward trend back from 2.5 in 09 when we first started benchmarking, down to 2.11 at this point in time. And those numbers at a state level have all also seen a decline. I haven't put the reference point in there, but there is a consistent downward pressure on comms. And I think during FY19, when we saw the market so competitive because there was obviously subdued activity, no surprise that competition was still being heavily challenged through price. That is, price being the common denominator by which people were trying to win listings and volume. So that would have only added to the downward pressure, outside of the fact that we are starting to see some efficiencies coming through across sales and PM. We'll touch on PM in just a second, which is allowing some businesses to look at the pricing that they're putting in market. And I think that's the real focus here, is to ensure that whatever pricing in market is relevant for your business, to ensure that you've actually factored in each component, whether it be sales, whether it be property management, or whether it would be right down to the individual, to understand the KPIs, benchmarks, and expectations around what's achievable. More importantly, what's a profitable transaction. You'll see there that we've just referenced the difference between VPA, when you're getting VPA and when you're not. I think the story to be told around VPA is that the industry is just a damn sight better at it now than it ever has been. But there are still pockets of best practice, and certainly pockets of where we're not seeing that play out. Some of that's obviously driven by demographic and geography. So as it relates to PM, again, let's look at the trend. It continues to be a downward trend. We've gone down 0.5% in the last 5 years. And again, at a state level, we've continued to see a downward pressure. Victoria and New South Wales have always been the lowest fee structure, somewhat reflective of average median rents, somewhat also reflective of probably a little bit more sophistication around property management historically, and the ability to be driving efficiency and typically leading those efficiency, that push towards efficiency. So we have seen a continued downward pressure across all states. WA has always been the anomaly there. We do have a lot of businesses in WA reporting on all-inclusive fees, and or do offer all-inclusive fees as something to their landlords, and that's why we often see the WA number continue to stand out in that sense. Interesting when we look at the high performers, which I say I'll talk to in a bit more detail in a few slides. High performers are not typically buying market share here to drive the scale and and efficiency, albeit there is a slight variation against the broader market, 6.9 against 6.7. There's a real story to be told there, simply around efficiency and a true understanding of what their property management business looks like as a standalone entity, and being able to ensure that whatever pricing they're putting in market is relevant for the structure that they have in place, and is also reflective of an appropriate level of return for each relationship that they have with their landlords, based on, again, average rents, number of properties under management, et cetera, as well as the benchmarks that they set for their property management teams more broadly to ensure profitability. So that's the first trend. The first trend is that downward pressure on commissions. The second piece is just this inability for the industry, or for participants in the industry, to rely on a consistent growth in both revenue and profitability. So inability to rely on consistent growth in profitability and revenue. Now, we all understand that there are a number of factors outside of people's control, the uncontrollables, that are always going to have an impact on business. They are the macro factors that the likes of which played out a couple of years ago, and arguably the likes of which are playing out now, that aren't within control. But that shouldn't always have the same sort of impact on profitability. And we are seeing the ability for many to be able to buck the trend against the backdrop, to still be able to outperform around revenue growth, or consistent revenue growth, and also consistent profitability growth. So you'll see there at the bottom, we've obviously seen a material change in activity from FY16, 17, which is the last reporting period that we benchmarked, of an average of 148 transactions per office, down to 116. But when you look at the revenue growth, there were still 46% of businesses in FY19 that were able to grow their revenue. So again, think about it, FY19 was a challenging year. 46% of businesses were still able to grow revenue, but that's dropped from our previous benchmarking, where it was 79%. The conditions were slightly more favourable. We certainly didn't have anything as significant playing out in the backdrop, which was the change in the serviceability criteria and overlay that APRA had imposed on the banking industry. But then also, when we look at profitability, you'll see there that 41% of businesses were also able to improve profitability in that challenging market of FY19. So this resilience piece is starting to be understood, and is starting to be built into a lot of real estate businesses, to ensure that they are insulating themselves as best they can to factors outside of their control, and trying to take and doing a good job of taking the reins to deliver predetermined outcomes to their business, or certainly putting as much framework around their business to ensure that the deliverables are in line with their expectations, and not simply reliant on market conditions and market activity in kind of a bit of a, well, we'll just see how we go, and it's potluck as to what our numbers are. It's really about delivering predetermined outcomes, or certainly giving them the best chance of actually coming through.
Dom, just before you go from that slide, can you just go back to it?
Sure.
I just want to check, is the revenue, you've talked about number of sales transactions down the bottom, at the top revenue, that's sales and property management?
Yeah, that's the consolidated revenue for the business.
Okay, just wanted to do a check with that. And have you got a figure that, if you look at, okay, we've seen a profit increase in terms of 41% of agencies have had a profit increase. That's over 2014, is that correct, or year on year?
No, so 46%. So in 2014, that was our 2014 benchmarking survey that would have reported the number of businesses that had grown revenue from the prior financial year.
Got it. Okay, good.
Whereas this year in 2019, we were asking businesses to report, well, okay, based on your FY19 numbers, how many of you actually grew your revenue compared to FY18, acknowledging that FY19 was that challenging financial year.
Great. And the only other question here, in terms of increasing the profit, we haven't got we haven't got margin here at the moment. So do we increase profit and do we increase margin, or do we increase profit because we grew revenue?
I can provide some further details on that and get a bit more granular. We did only ask in order to make the survey I guess easier. The challenge with benchmarking is quality in, quality out, and in order to get quality out, you need a great level of detail in, but you need to balance that with obviously the ability to engage with participants and keep them interested and not overwhelming them with 2 hours of sitting in front of a laptop inputting data. So we have got banding as it relates to profitability. We didn't actually ask for the exact dollars and cents, which makes it hard to pinpoint a specific profit margin. But what I think we need to appreciate here is that in the last benchmarking survey that we did in 16-17, the average profit margin for a real estate business across the country was 16%, or around 16 to 18%. So based on that and knowing what the challenging conditions were in 2019, it's fair to say that probably hadn't risen across the industry broadly. But we can, but if you refer back to the previous slide, back up in here, not the one, the next one that I was about to show, you can actually see where most of those businesses are demonstrating profitability at a state level as well. But to answer your question, Michael, I'll see what I can do and see if we can find like a median. But we do need to appreciate that we did ask for a banding of profitability just to ensure that we had ease of input, but obviously got as much value out of those inputs as we possibly could. Okay. So here, I mean, it's really interesting to see the impact on New South Wales and Victoria specifically. You can see that there's, a large component there of break-even and loss-making businesses, 14 and 13%. Maybe it's not a huge number, but some of the other states that have maybe, operated in more subdued and or less growth environments for a period of time. You'll see that WA that's obviously been through challenging backdrop for a period of time. There's less of businesses that are break even or loss making these days. The industry has either been cleansed because those businesses haven't made it through, and or they've adjusted to at least now be generating an appropriate level of profit. So whether that's just 1 through to 20%, which it looks like the majority of businesses are making, but there are still some examples there of businesses really generating good levels of profitability. But the interesting thing there for me around New South Wales and Victoria is just how quickly those environments were impacted, and the large number of businesses, because they're still big markets. So 13 and 14% of a big market is still a number of participants that were not able to adjust appropriately, and their financials have obviously demonstrated that as well. What's also interesting to look when we look at revenue and profitability is just, we started to do this back in 2017, was just looking at the revenue per FTE. So this is not per FTE sales or PM, this is per FTE across the business. And businesses typically are of a size of about 21. I think we've got a slide on here around that. So 21 is typically an average size business per respondents. And you can see there that there's a real discrepancy across the industry, across states, as to the efficiency that's being delivered, with New South Wales ACT delivering around 220K per FTE of revenue, compared to some of the other states.
By the way, guys, FTE is full-time equivalent, just the lingo of MacBank and the lingo out there, so good.
No dramas. So there's some lessons there from a New South Wales perspective around efficiency, and to me this all comes about building resilience, understanding benchmarks, understanding KPIs, and setting the business up for success, ensuring you're driving efficiency, and people are doing their roles around revenue generation and or cost management. So that's the second trend there, that piece around revenue and profitability, and the need to really build resilience around that to be able to deliver consistent revenue and or profitability growth. The third piece is just the continued increasing importance of property management. So how are we seeing this? Well, we're seeing it play out certainly by the skew of revenue within the consolidated revenue that's being contributed to by property management. So you'll see there on the right-hand side that WA and Queensland are generating in excess of 50% of revenue from property management back in FY19. There is a piece to be said there around, well, if they've got subdued sales activity, then clearly that will act favourably or show a favourable contribution from property management. I think there is an element of that there, but you'll see in a moment when I share, the average size of property management portfolios these days that we're just seeing property management being even more of a focus for businesses. And it's not simply about building recurring revenue and cash flow. I think we're starting to just get a true understanding and appreciation of property management. The clients, be both tenants and landlords, that sit within that part of our business, and the opportunity that sits there more broadly. So obviously Victoria, New South Wales, SA still a little bit lower on the spectrum. Again, there's probably a factor there around sales activity, offsetting some of that property management, but some opportunity for growth there as well. And WA, Queensland certainly leading the way around growing property management focus. So when we start to look at property management in more detail, there's a bit of information on here. So top left is, again, just looping back to the commission rates, excluding GST in all states. When we go to the bottom left, we can see the average portfolio sizes across each of the states. And the message there is continued growth. Melbourne has led the way, Victoria has led the way for a period of time. They continue to grow. It's fair to say that some of the other states have accelerated their growth and are actually growing at a faster rate than Victorian businesses on average. And I think that history of PM focus in Victoria somewhat contributed probably by a lack of franchise focus down there. There's typically more boutique businesses. A lot of the franchise groups historically have been focused on sales. They haven't driven the PM agenda, and the fact that they haven't really been as present down there until more recent times may have driven some of that agenda, but there's certainly a greater appreciation of PM down in Vic. And when we look to the right-hand side, you'll see how the average portfolio size has grown at a national level. So we've gone from 375 when we first started reporting benchmarking to 729. So, in essence, we're almost doubling over that 10-year period, and not a surprise to see from the blue line that the contribution on average of PM income to the overall revenue continues to head north as well. So this scale, this consolidation is certainly been playing out. We continue to see it. We've seen it quite a lot over the last 12 to 18 months. I don't think the current backdrop is facilitating consolidation at this point because of the mechanisms that the government has obviously put into play to keep SMEs going. And unless there's a poor timing issue around the removal of that support with obviously the economy coming back in, that will obviously do its best to kind of prop up and reduce any distress sale or forced sale to market and further consolidation. But I think there's also a comment to be made there around the fact that during FY19, that was a challenging year and sapped a lot of people's energy. And I think what we'll probably see in the coming months is potentially a number of business owners that may well say, this COVID experience is not short and sharp. It's going to take a considerable amount of effort. There's still this transformational agenda playing out in the background, and we might just start to see some of that succession planning start to hit market in the coming months when people realise that there's still a long way to go in order to trade through this. But we obviously wait and see how the market continues to react as well, with some early green shoots there, but and reasons to be optimistic. But it's still going to be a long slog. The final point on property management is that efficiencies are starting to be demonstrated here. So we're seeing the scale, we're seeing the consolidation, but we're also starting to see the efficiency piece come through. So this is the number of properties managed on average per property manager or property manager equivalent. So we have started to ask about the number of outsourced or offshore staff that people are utilising. I was a little bit surprised with this number because I actually thought it might be a little bit higher than 120 nationally. but it has gone up from 101 in 2016. I mean, more often than not these days, we are speaking with a number of people in the industry that are managing in excess of 150, some in excess of 2 and 250. And that all comes back to how the business is structured and how much they are embracing the likes of technology, outsourcing, and obviously that's been a huge agenda through COVID, as we've seen a real accelerated rush towards embracing technology through necessity, not choice, because of the social distancing. So through necessity, and I'm hoping that will be a favourable sort of hangover from the whole COVID experience, is people realising that the embracing technology is not as bad as people thought. The change management potentially wasn't as significant as an impact as people were expecting. Not to underplay change management, because it is a big challenge, but I think we'll start to see property management efficiency certainly coming through a lot more in the short to medium term. Obviously, that's where a lot of administration, a lot of process is currently incumbent in a lot of businesses, and we should start to see these numbers continue to report through. High performers are managing, on average, a larger portfolio. So 131 against 120. Again, there are certainly examples way in excess of those sorts of numbers. But it really just comes back to this leaning into to the tech play, understanding the potential as an enabler, and continuing to look at ways of driving efficiency and enabling people to add value rather than simply facilitate process. And that's where we really should be looking at technology and automation to improve not only business performance, but both the employee experience and also the client experience as well.
Dom, just on this one before can we just go back? So the 122 per full-time property manager, does that wash outsourced team members into that?
Yes, it does. It does.
Okay, good, great. Because one of the things I've seen a couple of times people do is say, my property managers are now managing this. And then it's like, well, how many people have got outsourced? I've got someone outsourcing this and this and this. Hang on, what are you including them in that particular figure? So, which is the accurate kind of view on it.
Yeah, it's a good point, and I think it's something that we need to continue to review on how we not only how we report this, but how we ask the question. Because I think what we need to appreciate, and I think this group, knowing the people that are involved with your group, Michael, is the fact that when we're talking about outsourcing, offshoring, I mean, we're typically looking at ways of delegating tasks out and automating tasks rather than roles. So I think when we came into this conversation around the likes of property management, and it was all about, well, how many have you got onshore or offshore? It's not typically property managers per se that are offshored. It's predominantly many tasks that are aligned to property management that are offshore, that are automated or offshored or outsourced or whatever the choice may be. But there's also a number of other tasks that have been outsourced from other functions as well. So there is an element of grey around this, because I think the industry is continuing to evolve its thinking around what outsourcing, offshoring, tech enablement does, and the fact that it is more task specific than it is role specific. And this all comes down to this whole future, the future of what a real estate business looks like and how it's constructed as we move forward, which will be arguably very different to the way it is today, which is very process and role specific.
Yeah, great.
So they're the three themes: continued downward pressure, revenue and profitability, accountability to, and building resilience around to enable predetermined outcomes, and obviously the increasing importance of property management. We then wanted to just dig into high performers and say, okay, well, where are the high performers in this subset, and how can we really start to drill down on some of the characteristics and of those and attributes of those businesses. So for the purposes of this report, we looked at high performers as revenue in excess of $1 million. Some that might be a bit challenging and saying, well, really, for the purposes of this report, it worked for us. Profit margins in excess of 20% or higher in FY19, which I think is certainly characteristics of a strong business, but also sustainability around that. And then, as well as the numeric elements that we asked the industry to report to us, we also asked a lot around the attributes, characteristics, and mindset. So this mindset of adaptation, back to our perspective narrative around three horizons and this universal arc of organizations, adaptation is really critical to any real estate business that wants to navigate the current backdrop, and more importantly, navigate the sort of business environment moving forward. It's going to be a key characteristics because change is the new norm. This isn't just a case of, okay, so we've had to change for FY19 for APRA changes. We've had to change now for COVID. There is just going to be a consistent ongoing theme around adaptation and being nimble moving forward so that you can set your business up for prolonged success rather than potentially going into this decline and demise and continuing to look at reinventing and disrupting it yourselves moving forward. So on the basis of overlaying this, 16% of our respondents were actually high performers. So we really focused in on that group and tried to understand, well, what's going on in their business. So no point looking at the top right in the first instance, because that just simply highlights the fact that we've removed $1 million from the group of high performers. But when you look at the change in revenue and change in profitability, you'll see that high performers, typically 64% of them against 44% of the broader market, were increasing revenue. So a larger component of them were growing revenue in a challenging backdrop. So let's explore that. And from a change in profitability, again, 54% of that subset of the group were increasing profitability against a challenging backdrop compared to 38%, which I still think is a pretty good outcome for the broader market. So we really got comfort from this, that there was a reason to explore this group because they were outperforming the market around revenue and profitability. So what are they doing in property management? Well, they're certainly managing larger portfolios. When we look at the numbers here, so we've got high performers at the top in FY18 and 19, and we've got the rest of the market in 18 and 19 below that. So what we're seeing here is a real push to growth and consolidation, and looking at managing more properties, and more importantly, managing them effectively. So this isn't a growth agenda for growth's sake. This isn't about buying cash flow and revenue. This is understanding the piece around efficiency through scale, but also giving consideration to this through a lens of clients and the ability to build out a client data set in order to deliver more services to in the future. Maybe not here and now, but just understanding the importance of scale, what that can deliver, again, both in a profitability sense, but also for the long term view of the business. We'll see that there's actually growth across the broader industry as well. There are less businesses managing less than 250, no surprise, because there's probably been less new entrants starting from scratch. It's been a tough environment to do that. But again, there has been a push through to scale across the broader industry, just not to the extent that we've seen play out in those high performing businesses as well. And as I referred to earlier in the piece, they're not buying market share. Yes, it appears that there is certainly a comment to be made around the 6.7 against the 6.9, but typically this is this is setting up a property management business that can adapt to scale with right infrastructure and continued ongoing review of infrastructure to ensure that it is delivering efficiency, that it is through that efficiency delivering profitability, and on that basis that it's set up in the right way, it's then easier to bolt in the additional portfolios and or facilitate organic growth, which hopefully we all know is a key characteristic for any business before you look to go out and potentially bolt on any acquisitions as well. So property management, certainly a key component of any high performing business. And I think we used to once talk about 250 being a bit of a bare minimum that you need to get to before you're really starting to hit your straps. I think any business sub 500 these days is struggling to really see the true benefits of property management. So there's still that we'll still see a lot of consolidation continue to play out on that basis, and or potentially a number of smaller operators that will look to come together to get that scale in the absence of equity to be able to grow, either equity to acquire or the capability and capacity to grow organically. So what's happening in sales? Well, these high-performing businesses also have larger sales teams. So on average, they have around 11 salespeople in their business compared to the rest of the industry that sits at about 8 salespeople. It's not about size of the sales team. Again, this comes back to efficiency of sales teams. So when we reported the number of sales per salesperson, it was 30 per 30 sales per salesperson for high performers against 23 for the rest of the industry as well. So they've got large property management businesses. There's an ability to clearly leverage those opportunities and turn them into sales. But it's not simply around leveraging property management. They have quality salespeople that they are benchmarking, they are setting KPIs around expectations, and more importantly, it's not simply around GCI, it's ensuring that those individuals in their own rights are profit centers, and a real consistent ongoing focus around that to ensure that any conversation that plays out because of success that may be around GCI splits, support, infrastructure are factored into the profit center for each of those individuals, and that we take this focus away from market share in isolation, and we understand that the broader impact of these people that we're bringing into our businesses and or we're investing in to grow their contribution to the broader business. So on average, there's a lot of the broader market, in excess of half of the broader market, that are still selling less than 100 properties per year in their businesses. But you'll see for those high performing businesses at the top there, majority of them are selling well in excess of 100 sales across their agencies every year. So there's a couple more kind of numeric bits here that I wanted to reference. We continue to obviously talk around technology. So, well, what is it that these high performers are doing, and what is it that they're doing better? Well, they are simply using more tech in their business. So you'll see there today, 5.5 against 4.8. It's not a huge swing factor, but I think the message here is that that we're seeing technology as a leadership agenda item for these high performing businesses. They typically have a broader leadership and or executive team that they are driving accountability to a number of different agendas. And I think that's a real challenge for a lot of smaller businesses that don't have breadth and diversity of thought and or leadership at the top, because it might be reliant on 1 or 2 people, is ensuring that we're bringing future leaders through and or empowering the teams to support some of these agendas. And technology really should be one for all principals, either themselves or certainly investing in the right people and having it really quite high at the top of their agenda, because it is a game changer in ensuring that it's an ongoing conversation. There is ongoing accountability to it, and setting a business up that is aligned to embracing technology. So it's one thing to have it as a leadership agenda. It's another thing to have some accountability around leadership to it. But I think ensuring that the business is set up to embrace technology and embrace technology on an ongoing basis, to try new things, to lean into the agenda, learn from mistakes, and look at a future that's probably going to involve technology kind of coming and going or being interchanged within a business almost on a plug and play basis, rather than this philosophy of a single user sort of infrastructure or architecture that does everything. I think we'll see, certainly for the foreseeable future, to the medium term, this plug and play. So, all right, well, what I've got here and now is right, it's working, it's best practice, but maybe it won't be in the future. Maybe that tech stack will have its challenges because of its parent company for a whole different number of reasons. And maybe in 12, 18, 24, 36 months, I might be looking at another part of my infrastructure that delivers that service that's better at that point in time. So I think that sort of mindset rings true as we look at technology, but certainly, again, high performers have accountability to tech, and it's high on their agenda. And I think the other piece that we always talk about, or we've talked about more recently, is this value-added services. So this is the building out adjacent revenue streams, and it's really interesting to see here what's happening. So high performers typically, on average, offer less value-added services than the broader market. Again, 2 to 2.4. The story here for me is all around superior execution. It is focusing on one or two of those services that make sense, that are aligned with the vision and strategy for the business, that are aligned with consumer expectations and what consumers are asking for, and looking at focusing on one or two of those to deliver superior execution on those before looking more broadly. So I know from our point of view, the conversations that we've had where people have been saying, well, where do we go? What services should we look at first? What's everyone else doing? Everyone's doing this very, very differently. But I think the key here is to just look at one or two and really invest. Don't try to commit too early, but make sure that it's integrated comprehensively into the broader business seamlessly to ensure that the client experience, the employee experience are great, because when that happens, you've got a greater chance of success rather than just simply finding the right partner or JV or structure to integrate it. We need to be thinking through it through a client lens and an employee lens as well. So I'll touch on the next slide where people are focused and what the opportunities are. So we'll touch on that in a second. On the left-hand side, again, comes back to this mindset and attributes, and it's all, you always run the risk when you ask real estate business owners to rate themselves on certain metrics, because typically the eternal optimists and potentially maybe rating themselves ahead of where they potentially are. But there was a real difference when we looked at these high performing businesses on their self-rating. You'll see their adaptation and resilience. There's a real disparity between these high performing businesses self-rating and the broader industry. And that also flows through to entrepreneurialism and vision and strategy, which, when we move through the slides, you'll see why these characteristics are so critically important. And it's really, I think, essential that every business has these as characteristics and accountability to these across the broader leadership team, and has that diversity of skill set in order to deliver high performance.
Dom, can I just do a time check with you? I'm just aware
Sure.
that some of our guys, how are you looking time-wise?
Yeah, there's about three more slides.
Okay, we're perfect. We probably won't do a breakout session after this, guys. We'll do more of a debrief in terms of our next week, where we can peel back some layers on this. This is great, by the way, Dom. It's just a beautiful sort of lifting us up above and saying, okay, let's have a look at this on a broader scale and a broader basis as to where we're at and how we're going. So back to you.
All good. Thanks, Michael. So we'll touch on the value-added services. So if you look on the right-hand side here, this is, well, where's everyone playing at the moment? What services are they offering? And where do people see the opportunities? So again, we've split it out, high performers in orange and the rest of the market. No surprise there that you'll see that utilities connections is the highest utilized service, typically because it's the easiest. There's a number of providers out there that do it very well, typically relatively straightforward to bolt into the value proposition as well. But when we look at the coming 12 months, it's interesting to note that some of these high-performing businesses are starting to look away. In fact, more of them are looking elsewhere than the rest of the broader market. And where are they looking? Well, they're typically looking at maintenance and individual occupier services, which is concierge services, as the next opportunity to leverage. So again, comes back to superior execution before looking elsewhere. And they'll be investing heavily in those two specific opportunities to ensure that they are looking to set them up the right way to integrate them comprehensively into the broader business. It's no surprise that insurance and financial services is typically less reported. They are more complex, and I think it'll be a while before we.
Are you guys hearing Dom?
No.
Dom, we might just need to come back to you. Are you there, Dom?
But certainly still very much high on the agenda. I think the key here.
Dom, Dom, just so you know,
Yes.
we lost you
Okay.
at insurance and value-added and financial services. We lost you there.
Okay. Can you hear me okay now?
Yes, absolutely.
Okay. Yeah. Sorry, it did come through as an unstable internet connection. Sorry about that. Maintenance and individual occupier services are the next sort of opportunity that most of the industry sees as a focus. And again, those high performing businesses will be looking to really diligently explore those before releasing them and seamlessly integrating them into a value proposition. And that's really the message here. Insurance and financial services will continue to be the opportunities that the industry looks into, but I don't think we'll see them really work well in the space because of a lot of the investment that needs to be made around compliance and how we really integrate them comprehensively into the broader offering. But there's certainly some medium-term opportunities there, and I think we'll start to see them more broadly once a few of these initial value-add services are built out more seamlessly. Around the challenges, the people piece continues to be the number one challenge, again, both across high performing businesses and the broader market. Less of an agenda for those high performing businesses. I think there is a difference in focus. I think with high performing businesses, it's around training and developing into the roles of the future. Whereas I think the broader market, yes, that's somewhat of an agenda, but I think there's still some challenge around potentially getting the right people for the future and not necessarily having them in the business as well. So that certainly should be where the industry is very focused right now, is the skills for the future and what the business is going to look like. And in order to do that, clarity of vision and strategy is really, really key. And I'll touch on that in just a second. Driving efficiencies, I think, again, getting back to some of the characteristics of high-performing businesses, I mean, they're across this piece. They're driving efficiencies. They're utilising technology. So again, that's probably why we're seeing the discrepancy there across the broader market. So where are people focusing? We're literally on the last two slides now. Interesting that high-performing businesses are really focused on vision and strategy, and there's quite a disparity there from the broader market. And this is a real passion for me, is to drive this vision and strategy agenda across the business. There are many businesses out there making decisions without a real long-term agenda in mind, and they're simply making decisions based on the here and now. So some of those will not be aligned to what potentially is in their mind as a vision and strategy. And until you really invested the time to articulate that, have clarity, not just for yourself, but across the broader team, to ensure that everything that's done within that business is aligned, the decisions that are made, the partners that are introduced to the business are all aligned with that vision and strategy, it'll come unstuck. It'll either come unstuck at an employee level or it'll come unstuck at a client level as well. So the vision and strategy piece for me was a real call out there. And when we look to the right-hand side, it's interesting to note the broader industry is still very much focused on reworking the business model. So they're still playing catch up in understanding what they want the future to look like. And they're also really focused on this efficiency piece. So they haven't really got the right insight and oversight around cash flow. You'll see that in the bottom right-hand side there. The majority of high-performing businesses have already got that nailed. It's still a focus, but they know how to manage their cash flow, and they will continue to do that. Whereas I think the reason that the rest of the market is sitting at 75% is because they're still getting their head around how to manage cash flow within the business and ensuring that they've got the right accountability and skills to do that, not just within their bookkeeper. I'll send you the slide deck, but that's just a summary of the high performance characteristics. The final piece that I just wanted to leave you with was this. Don't focus too much on the wording. It's really the right-hand side there that screams opportunity to me. So we asked the industry to rate these characteristics around importance and how important they are to success and performance on the left-hand side. And then across the bottom, we asked everyone to report self-rated performance. So in the top left-hand corner, seen as important but need help achieving, vision and strategy. Really poor rating for the industry more broadly around vision and strategy and having clarity of that, but they also appreciate that it's so critically important. can see that people believe that they're performing well against the important metrics of people, client, and adaptation. I think that's interesting, and I think there's some reflection to be had there. The industry typically rates itself very, very good on innovation, but as we've seen, there's still some consideration around innovation and what performing in around innovation actually looks like. And really, in conclusion, I think that the bottom left there for me around execution, people not understand, or the industry itself not understanding the importance of execution, and obviously not seeing itself as really doing that well. You can have the best vision and strategy in the world, but if you don't have an ability to execute and execute with precision, with diligence, and with the long term in mind against a clarity of vision and strategy, you're really setting yourself up for failure as well. So certainly where we're going to be focused in the foreseeable future is helping our clients on this journey around vision and strategy and superior execution to ensure that, that the decisions that they make for their business are setting themselves up for success in the future. That's it from me, Michael.
Dom, I think it's really interesting that people have rated execution and resilience and entrepreneurship low as it's not that important, versus, you know, in actual fact, they're the biggies to and they're the big skill sets to be able to make sure the vision and the strategy is actually realized. So fascinating from that point of view. Hey, this has been awesome, guys. Can we give, first of all, Dom a round of applause? Well, virtual round of applause. Hey. And Dom, one more question that I've got to ask you, and that is, if we look at the big picture, you know, we're coming out of isolation. We've got more levels of releasing occurring around economic sort of growth and opportunity. What do you see? What are you seeing as, and what's your advice that you're giving clients around how to actually come out of this in the most effective way? I mean, everything you've covered, I think, is incredibly valid. Are there any other tips that you're seeing or cautions you'd put in place?
Yeah, look, I think, I mean, for us, when COVID hit, the immediate focus was on the well-being of our clients. So it was really getting on the phone, checking in, what can we do? And obviously the banks were empowered with implementing a lot of the support mechanisms through the likes of the payment pause, and obviously some of the funding options that were coming to market. So it was really enabling that. Our focus then switched to helping our clients at a more granular level around cash flow to ensure that they understood what was potentially coming through the months of June, July, and August, where the activity that's been subdued for the previous months is now going to start to hit the bank account. So that's been our focus. I think my concern, I think where I see the market now is that there's a lot of reasons to be optimistic, because we're starting to talk about easing of restrictions. We've talked about flattening of the curve for a period of time, and clearly we've seen the likes of auction clearance rates and general activity start to pick up. I think we still need to be mindful that we are still sitting at an activity level probably somewhere between 25 and 35% generally lower than we were this time last year. And this time last year, we were still at quite historic lows around activity as well. So I just think we need to be careful how we're looking at this optimism. We should all be optimistic, but I think we can't get too ahead of ourselves in terms of the focus that we've been putting on our businesses to ensure that they have been able to trade through. I think if we can just keep that focus about building resilience around reinventing what our businesses might look like, listening to feedback from our clients about how they've seen the transition, how our employees have seen the transition. I think there's still a journey that we should be on there and not get too caught up in getting back to what we did beforehand, because that's just kind of what we're used to. But I think the longer that this is going on, we're all probably getting a bit more comfortable with being in this space, this being uncomfortable and trying new things. And the other point is just well-being. I mean, I just think we just need to continue to focus on the well-being of our staff. Leadership is hard when you're in an office to try and bring people all on a journey. It's even harder when you've got your team working remotely. And as much as there are positives that come out of working flexibly, and I'm sure there's a number of stories around employees enjoying it, I think it's critical as leaders that we understand each individual more so than we've ever done, to understand how they're truly feeling around this. And we lead with empathy, we lead with humility, We lead with vulnerability. I think there's a real opportunity for business leaders in this environment to step it up, not just now, but for the future as well.
Yeah, excellent, fantastic. And a couple of questions coming through on the chat we'll go through. And at some point in time, can you actually make me host again?
Oh, sorry. Yep, sure.
All good. And there clearly are some operators, if they didn't make money in the 18-19 financial year, there's a damn good chance they're actually going to, even with whatever government support you want to throw at those businesses, they're not in a strong financial position at this point in time and heading into next financial year. Where do you see the opportunity there? I mean, is it the opportunity to look at acquire? Is there opportunity to look at folding those businesses into, from a management point of view? They might have a small rental portfolio. I'm overrunning the business. Let me grab one or two people that I think once upon a time would have thought, well, hang on, you're an owner of the business or you're a shareholder in that business. We won't even bother having a chat with you. Are there opportunities there that you're seeing?
Yeah, definitely. I mean, the market is pretty subdued at the moment around activity. So the M&A activity that we that's our bread and butter that we facilitate a lot within the market. I think both vendors and purchasers are kind of sitting on their hands because no one knows exactly how this will play out. How do we deal with the impact of COVID on what property management might look like within a contractual agreement, and how do we kind of mitigate that through retention clauses, etc. So we've had a number of conversations around that, and the people that are looking to transact are certainly amending the likes of retention, typically having longer retention periods and or a larger component of the purchase price at the back end to mitigate that. Excuse me, but we've got to appreciate that there's two sides to that. Both the vendor and the purchaser need to be kind of in the same space. I think where we are at the moment, to the point I made earlier, is we're yet to see the cash flow, the real true cash flow implications of what's been happening the last few months. They will start to play out more so now in the next 2 to 3 months. And that's where we'll see, well, have the changes that business owners have made to date been enough? Have they actually gone through a cash flow forecast to understand the implications? Is the payment pause that they've entered into enough? Interestingly on that, we've actually seen a number of businesses that took up the payment pause actually request to get back to paying because things haven't worked out as badly as they thought, and or they've made the changes to free up cash flow. So I think we might start to see some activity of business owners that potentially aren't going to make it through. We'll start to ramp up in the next few months. There is still this energy piece of do I have the energy to go through this for not just the next 3 months, but 3, 6, 9, 12, and however long it takes to get back to where we were, if we ever do. I think the opportunity is strategic. I think businesses are more open. The industry is more open than it's ever been around collaboration, and we're starting to see some parties come together to understand that there is a greater good to be had from removing duplication around back office and consolidating a business that will be better performing than it would be rather than being two standalone entities. So that's definitely happening. But I think for anyone that wants to continue the growth agenda, I think I would have a look around you right now, work out where you want to be, where the growth might come from, and knock those doors, re-engage with those individuals and see where they're at. Because I think there are a number of people that will still be making those decisions around exiting, and we'll see further consolidation certainly through the back end of this year.
Yeah, fantastic. Awesome. Now, I know you had a few of your guys tuning in today too, so hopefully they've enjoyed hearing Dom in delivery mode. I just think it's awesome that we've got a partner in the real estate profession and also within RER Network that's helping us navigate this, giving us insight and perspective. Guys, a lot to reflect on out of today. Would you agree? Yeah. So really appreciate it, Dom. We're not going to go into a breakout now. We'll get on with a productive day, but I would like to do some work on this next week, guys, and start to look at where are some opportunities. Keep in mind what we're doing now with the Leader Mastermind series is one, we've got a guest speaker, and then the next session next week is we're going to work on this, peel back some layers and really get into implementation. And Dom, as you know, my favorite quote is the power of an idea is in its implementation. I just prefer the word implementation than execution. I think it's like a bit, hey-ya. So let's implement rather than execute, and achieve some fantastic results. Thank you so much for your energy, your effort, and your commitment to sharing great strategy. And yeah, I agree. Pete, round of applause from there. So all the best, guys, and thanks. Get into a very, very productive day. Appreciate it. Bye for now.
Thanks, everyone.
Thanks.